Good Saturday morning to everybody, and welcome to Mortgage Matters Radio Show and the Connecticut Real Estate Edge podcast. Along with Rob Weinberg, I'm Gary Byron. Rob, hey, good morning to you, my friend.
Good morning, Gary. How you doing?
As always, man, it's tough out there. I'm just trying to hang in there over here. How about you? What are you up to?
Same thing, just every day is a struggle, like you said, making it through one day at a time.
That's exactly how you have to take it nowadays, one day at a time. Although you probably have a schedule which you're booked out days in advance, I would imagine, right?
Yeah, I try to keep a pretty tight schedule. I mean, most people nowadays we're meeting over the phone or online, so it's a little more flexible. But I do still have clients come into the office.
If it were me, I'd want to meet with you in person. So if I called you on Monday, let's say, how soon would you be able to meet with me in person?
In person?
Within a week?
Yeah, within a week, sometimes a couple days. I try to do a lot of appointments back-to-back in person, so if I'm going to be in the office, say, on a Wednesday, I might have a client come at 10, another one at noon. You know, I try to space them out so I can keep that strict schedule. But like I said, I mean, probably 80-90% are online or over the phone only.
If it were up to you, think of these pre-COVID days. What do you think is more effective? What do you prefer?
In person.
Yeah.
Absolutely in person. I think people just don't take the decision as seriously over the phone. It's just another call or meeting. But sitting down in person, and the clients that I've done that with even years later, it's more effective. Like everything that I'm talking about, what they're talking about, it just gets absorbed a little bit better when you're in person. You have that personal connection, handshake, whatever it may be. You know, that's important. But the market is shifting. You know, it is.
It is. Are we seeing, in which way?
I mean, I think the obvious one, Gary, is the interest rates, you know, have shifted just significantly in the last couple of weeks even.
So they've gone up.
Gone up considerably in a short period of time.
Well, you predicted this months ago.
Always, of course. We knew it was coming.
But here's the thing. The inventory is still minimal.
It is, and I think it'll continue to be minimal. There are some ideas that I have for freeing up inventory and creating your own inventory even in some cases, but that's a topic for another show, definitely.
That's going to be an interesting topic.
But, you know, there's been just the sentiment in people that are buying and refinancing has shifted because of the fact that the mortgage will be more expensive. Even if it's another $30 or $40 a month, if you add that up over many years, it's gotten a lot of people off the fence to say, I got to do this now. Again, whether it be refinancing their current property or buying. I mean, the media has people a little bit spooked, especially with all this talk about the Fed raising rates. And they don't control rates. The Fed does not control mortgage rates directly, but they do indirectly. And the decisions that they make with the Fed funds rate, it's meant to actually affect short-term debt like credit cards and auto loans, but it does trickle down to mortgages. So as we sit here today, all of the information about raising rates, that's already been priced into the market. A lot of consumers I've been talking to have said, oh yeah, I heard they're raising rates, as if it hasn't happened yet. But it's one of those cases of, you know, buy the rumor, sell the news. And right now it is the rumor, and it's going to happen. So it's already been priced into the market. Both the stock market and the bond market have had that happen.
So why can refinancing when interest rates are increasing make sense then for a homeowner?
There's a lot of different reasons that we'll cover, but I think it really comes down to taking a step back from just looking at that interest rate and looking at the big picture of your financial portfolio, of your personal finances, of where you are. Interest rate is one component of that. Only one, but there are a lot of other components that are important in making financial decisions besides just the interest rate. And we have to also consider the fact that refinancing to get a lower rate, that's something that's been very popular lately, but go back several years and there wasn't that much of that going on because the rates were higher then. So refinancing to get a lower rate, we've talked so much about it and it's great, but if you have that 2.5% or 3% or even 3.5% rate, if you get a new mortgage today, it's most likely going to be higher. I mean, there's certain cases that it won't be, but we have to look at, does refinancing make sense for your financial plan? You notice I didn't say what's the rate or what's your monthly payment. Does it make sense for your overall financial plan? What are your investments doing? What's your retirement look like? Where are you at with your real estate, be it one property or multiple? We have to look at that. And then big picture inflation, that's really the reason that rates are going up, is because of all this inflation. And inflation is the arch enemy of mortgage bonds because it erodes the return that someone would receive on a mortgage. If you think about it, if you're an investor, and people that invest in mortgages are like pension funds, hedge funds, very wealthy sovereign funds and people like that, or entities like that, they're just looking at what's my return. So they buy a mortgage bond and it pays 4%. Well, if inflation goes up, then that money they're getting from that 4% is worth less, right? You can buy less with that dollar. Mm-hmm. So they don't want to really buy at those low rates, knowing that the inflation's going to go up. So they're going to demand a higher return. And that affects everything. It affects the gas in your car, the price of groceries, and in this case, we're talking about mortgage rates. So it all comes full circle.
So then what do you say to someone who has the idea that refinancing to a higher rate is not part of a smart financial plan?
Well, what I would say to that person is, knock it off. I'd hit him across the head and say, every situation is different, and you can't make a blanket statement and say it's bad, because I'll tell you stories where going to a higher rate actually made people a lot of money or saved them a ton of money. So I think the first concept that someone needs to understand that has that mentality is, what's debt consolidation all about? If mortgage rates are higher, then that means credit card rates are going up. That means auto loan rates, all these other types of debt that have interest attached to them, those rates are going up as well. So it's all relative. And even if your mortgage rate was 5%, which sounds crazy, right? That's a high rate. Or even 6%, why would you refinance? Because if your credit card's at 20, 30+%, doesn't it make sense to take a hit on one side of the portfolio to make it up somewhere else, right? Mm-hmm. So you can take one step back with your mortgage rate, but take 2 steps forward by getting rid of your other debt. So that's the first concept. The other thing is mortgage acceleration we've talked about. When rates are going up, mortgage acceleration is a huge, huge advantage, which really refers to paying your loan off early. So when your mortgage rate is super low, it's not as attractive to pay it off quicker because it's such a low rate, right? But when the rates are going up, it makes more sense to pay that loan off quicker. Right? Get rid of that interest charge. The other thing is adjustable to fixed rate. We haven't talked about it in so long just in society about these adjustable rates, but they used to be a huge thing. People would take these 2, 3, and 5-year adjustable rate mortgages and just plan on keeping them for a couple years and then refinancing. And while it's been seldom, some people have done that, especially my higher net worth clients, people with the higher loan balances. They'll take an adjustable rate to save maybe a quarter or a half a point off the fixed cost. Now they're looking at refinancing. Even if their rate may go up a little bit, they can lock in that long-term money versus the adjustable rate. Who knows what it'll be in a year? Who knows what it'll be in 2 or 3 years? So it's one of those cases, a bird in the hand, worth 2 in the bush. If you know what your mortgage payment's going to be now, let's say it's going up $100, isn't that better than the unknown? It could go up 3, 4, 500. If inflation keeps going the way it is, that's possible. I'm not saying it's going to happen, but it's possible. I try to be conservative when I'm going through these financial plans with my clients, and we need to look at what's the best thing that could happen, but also what's the worst. And with these adjustable rates, locking them in now while rates are still relatively low, historically low, makes a lot of sense there. And the last thing I'll mention about why would it make sense to go to a higher rate while refinancing is PMI elimination. So when you're buying or refinancing, if you don't have that 20% equity, you're typically going to have the PMI or the mortgage insurance. FHA loans have it on no matter how much you put down, they have the mortgage insurance. On an FHA loan, that mortgage, that PMI insurance adds approximately 0.8% to the rate of the mortgage. So if you have a 3% mortgage on FHA and you're paying 0.8% of PMI, your blended actual rate is 3.8. You take the 3% mortgage rate plus the PMI rate of 0.8. That's your blended rate. So if you have a 3.8% blended rate and you can refi at even 3.6, 3.5, 3.7, anything that's less, it's going to make sense. Even though it may not be something you're going to brag to your friends at the bar about or your family at Thanksgiving, it's still historically a great rate. The statistic is last 30 years, 6.5% has been the average mortgage rate over the last 30 years. There have been times in the last 30 years where the rates were, 15% or 12%. There's also been times like recently where the rates have been 2 and 3%. But that average is what we're looking at. And if you can get a rate today better than 6.5, then you're doing better than average. So don't beat yourself up about it. There are ways around it, as we'll talk about.
So you may not want a PMI. I know sometimes you don't have a choice, but if you do have a choice,
if you do have a choice, you don't want it. It's just if you're trying to buy or refi and you don't have that equity position, or you need to use that FHA loan like we're talking about because of your credit, or an event that happened like a foreclosure or bankruptcy, you don't have a choice. You need to take the best loan that you can get at that point and look at it over time.
What are some specific strategies then that homeowners can use to refinance in a higher rate environment? To save more money over time.
Right. So we were just talking about debt consolidation, so that's a big one. But one of the things that I like to do, which is a seldom used, little known strategy, is to use a debt consolidation refinancing loan and combine it with a mortgage acceleration loan. And here's what I mean is, if you're going to do a debt consolidation refinance, the whole reason to do that is to save money. And typically it's going to mainly be saving money on your monthly payment. $500, $1,000, even $2,000 a month is possible with one of these debt consolidation loans. But what happens a lot of the time is, especially those that are financially undisciplined, they'll save all this money and they feel great. But then you go back to them 6 months, a year later and say, well, you saved $1,500 a month. What'd you do with that money? Where'd it go? Did you put it in the stock market, retirement portfolio? Did you buy a property or an asset with it? And they'll say, no, I don't know what happened to the money. It's what I call evaporation, right? It evaporates into their budget. So the way around that is a strategy I teach where you take the money that you were saving on that consolidation refi, again, couple hundred, couple thousand a month, and then we project out and run modeling. What does it look like if you took that $1,000 a month and put it on that new mortgage? Think about that for a second. You're saving $1,000 a month by consolidating your debt. You take that $1,000 and put it on that mortgage principal. In a lot of cases, you can actually take a 30-year mortgage and pay it off in a third of the time or less by using that. And you could do it on any level. You could take a 15-year mortgage and put an extra $300, $400, $500 a month and pay it off in maybe 5, 6, 7 years. There's everyone's in a different circumstance, but the interest rate at the end of the day in this scenario doesn't really matter because you're paying additional. The interest rate just dictates that minimum payment and that interest that you're going to be contractually obligated to pay. But if you're putting an extra $500,000 plus every single month, that effective interest goes down, and that interest rate on the paperwork, it's really irrelevant because that's based on you making the minimum payment every month. So that's got to be a huge eye-opener. It's a paradigm shift, but that's a strategy that I use with almost all my clients right now. And the second one that I'll mention here is what I call and discuss as the two-step refi. So it's going to be step one, solving your problem. Maybe that is consolidating a second mortgage, consolidating debt, going to, restructuring your loan for whatever reason you may be. Everyone's got that different reason that they need to look at refi, but it's a problem that the refinance is a solution. So that's the step that we need to take first, is solving your money, or solving your issues with your money, getting you right side up on your budget, saving you money on interest overall, not just on the mortgage, but on your credit card debt, on your medical bills, on your student loans. A lot of these, again, the interest rates are going to be going up if they haven't already, so you need to prepare for that. Then once we actually do that initial refi and we solve that problem, we're not really concerned about the rate on that first loan because it was meant to be a short-term loan. When I mean short-term, I'm talking about less than a couple of years, okay? Then we do an evaluation at 6, 8 months, 12 months. Where are you at now? If you do what we preach and you actually kept yourself in a good financial circumstance with your debt, you got your credit score up or whatever the case may be. Now you can do that second step refi. Now that second step is going to be a more long-term refinance. It's going to be that 15, 20, or 30-year fixed conventional mortgage that doesn't have the PMI, or if it does, it's going to be a lot lower. And then we can look at lowering your rate. Then we can look at all these things because you'll be in a better position to be able to do that. And like I said, Gary, sometimes it's going to be as soon as 6 to 12 months after you get that first mortgage that we can look at another one. But for some people, it could be 12, 24, 36 months. The idea is that you have that opportunity queued up. It's ready to go, and you're in regular communication with an advisor so you can strike while the iron's hot, whether it be on the level of the interest rates, whether it be on the level of loan programs, your credit, or the equity, that sort of thing.
So then give me a few examples of people who have refinanced and raised their mortgage rate, but still saved money over the long term.
Yeah, there's some great stories here that I can tell. I know we're limited on time, so I'll keep it to just a couple. But a gentleman that I've worked with a couple times came to me the end of last year, and he got a super low rate when I did his refi many years back. He was in the very low 3% range on a 30-year mortgage. But he had this opportunity come up with a friend of his to do some home flipping, to do some, profitable, hopefully profitable real estate investing. His friend was a pro at it and really just needed his capital. But like many homeowners, most of his money was in his home. It was in the equity in his home. He was scared about getting an adjustable mortgage like a home equity line of credit, and he had heard me talk about that. So we explored doing a cash-out refi, and his initial reaction was, but what about my low rate, right? This super low rate that he had. And believe it or not, we actually did go ahead and move forward, and we raised his rate. It went from, like 3 1/8 up to almost 4%. He had some, challenges with his credit. There were some things that made his rate higher than maybe the market rate at that point. It was a cash-out refi. He was tapping 80% of the equity in his home. And when you go to 80% for most products, that's the max. So they do penalize you on rate. But he was like, Rob, I know I can make a lot of money with this money. Does it make sense to refi, to go from that low 3s to 4? And we looked at it and said, well, what's your projections on your profitability with this money? And he had shown me some papers from his friend on the last couple flips, and his friend was getting like a 20% annual return on the capital invested. So we figured even if he could only get half of that, 10%, it would still be a good use of the mortgage, the equity in his home, taking that higher rate. Long story short, he took out $100,000 in equity, gave it to his friend, invested in this flip. He ended up actually making 30% return in only 9 months. Didn't even take a year. It was 9 months. And I mean, is that a no-brainer? Like borrow at 4%, get a 30% rate of return? Who would say no to that?
Right.
Even borrow at 6% and get 30%. If I said to you, borrow at 10% and get 20%, does that make sense?
No, it's double.
I mean, it does. So that's why I'm saying get out of that notion of thinking, oh, my rate's going up. It's like compared to what? Right? What are you actually getting in return on that money? So that's a huge example because I know a lot of people right now are thinking about buying or refinancing and taking money and getting another property. And that just shows you it's not about how much you actually pay on that money. It's about what you earn from it. So that's example one. The second one I'll give you is a family I worked with in Windsor recently. I had actually done a refi for them about 2 years ago. They were in the mid 3% range on that loan. We consolidated a bunch of debt. It was a veteran that I worked with, just did a great loan for them, saved them thousands of dollars a month. But the wife in this situation came to me about a month ago and said, Rob, I started this business and I need capital for this business. I charged up some credit cards getting things going. I need to pay those off and I need some extra money to get this business off the ground. They had a considerable amount of equity. Just in the last year or two, their home had gone up, like most, quite a bit. So their rate went up from 3.6 to like 4.25. So it went up, quite a bit there. But what we were able to do is consolidated $80,000 in their credit card debt. Okay, considerable credit card debt. She was paying like 15-20% interest on those credit cards. So we consolidated all that debt and saved them $1,500 a month. Okay, and she also was able to get that cash infusion that she needed to keep that business rolling and really get it off the ground. So by taking that money that they were saving, the $1,500 a month, and applying that to the new 30-year mortgage, they're going to have it paid off in only 7 years. So again, where does rate come in now? Are you asking what the rate? If I tell you my home is paid off in 7 years, who cares what the rate is, right?
Sure.
That's better than the guy paying a 20-year mortgage at 2% that feels like he's got the world on his shoulders because he's got a low rate, but it's not, again, about the rate today. That even someone with a 2 or 3% rate, how much interest is that going to cost you over the next 10, 20, 30 years? The bank lures you in with the low rate, but mortgage interest is front loaded. So look at what you're paying over the long period of time, not just the rate today, not just your mortgage payment today. What's it going to cost you over 10, 20, 30 years? That's why having the financial plan in play, as you're seeing, is way more effective than just looking at get me the lowest rate.
Folks, you are listening to Mortgage Matters radio show and the Connecticut Real Estate Edge podcast, along with Rob Weinberg. I'm Gary Byron. You can contact Rob very easily at 860-413-3938 and check out his website. It is ConnecticutMortgageLending.com. I will repeat that for you momentarily towards the end of the show. What about HELOC? HELOC versus a cash-out refinance that we talk about, oh my goodness, all the time. In an economy where, the interest rates are increasing, as you just mentioned.
Yeah, so a lot of people right now have an impression that their rate is so good on their mortgage because they did that refi in the last few years that the only option that they would look at for tapping equity is to get a line of credit or a second mortgage against your home. And I would really caution anybody, and I do every day, because I've been through enough of these cycles. I've seen what happens when inflation is ridiculous and the HELOC rates go up. Mm-hmm. So you can really be caught with your financial pants down. I've seen payments go from $500 a month to $700 a month very quickly. Or for retirees, $200 a month goes to $300 a month. That means a lot when you're on a fixed income.
Oh, yeah.
So I really want to caution everybody to be so careful and just don't do a HELOC right now. HELOCs were cool a year or two or several years ago when the rates were in a downward trend and all that. Now that the economy shifted, now that we're seeing inflation, now that we're seeing increased rates, a HELOC's a ticking time bomb. It is a credit card on your house. So if you thought just having a mortgage was risky, what about having an actual credit card attached to your house and having the payments go up? It does happen. So you will be caught off guard because everyone is. And the cash out refi is a better idea. Even though, again, you might take a little bit of a hit, it's certainty.
Rob, we already mentioned it a few times already this morning, and I just want to get your opinion. We've been talking about mortgage rates, these interest rates that just, they keep going up. What is your opinion on the direction of the mortgage rates over the next, let's say, I don't know, year and a half, or maybe 2 years,
Right.
2.5 years?
So
let's do 24 to 36 months. Okay.
All right. So let's say next 1 to 3 years, somewhere in there,
All
right?
Sure.
So I follow a lot of economists. Some are mortgage specific that track interest rates. Others are just general economists that, look at interest rates and look at inflation and all these things. And I look at all the opinions to kind of come to a consensus. And what I think we've seen so far is we've seen the rates go up already so quick in anticipation of the Fed raising the federal funds rate. I hope to think that we've kind of gotten, at least for now, to a top of rates. Maybe they went too high too quick, which is normal. They take so long to come down and then they just skyrocket up, and by the time you as a consumer figure it out, it's too late. So I do see that we have the potential, maybe not this year, but I'm thinking next year into 2024, when the country enters a recession, which is definitely coming. We're overdue for one. And historically, when we go into a recession, the Fed has to lower rates in order to spur economic activity, spur spending, business, etc. So I feel like those that are buying or refinancing homes right now in 2022 should have a great opportunity either towards the end of this year or into next year in 2024 to be able to then refinance when we see that deflation come, when we see the inflation go down. And there will be a refinancing boom. Mark my words. The people buying homes right now during 2022, they will be refinancing. I just don't know if that's a year from now or is that 2 or 3 years from now, but there is going to be this period. So don't fret. Don't worry. Don't feel like you missed the boat. Just make sure you've got the right advisors. Make sure you've got the right team to guide you so you can strike while the iron's hot. And as soon as the rate comes down to the level where it makes sense to refi, we can queue you up and get that loan rocked and loaded.
All right, let me ask you one more question because I'm running out of time here. What about some ideas and strategies for home buyers who are purchasing homes right now and thinking that they missed the boat on an all-time low interest rate? You started to go into that.
Yeah, so you didn't miss the boat. You're still getting a great rate, even if it's, in the high 3s, 4s, or even 5s. It's better than the average. So look at that and take a step back. I would caution you, don't pay a bunch of points. Mortgage companies offer loans with points or no points. I do not recommend paying points now because you're not going to have enough time to recoup it. If we do have a lower rate environment in a year, 2, 3 years, you're going to refi at that point. So if you paid a bunch of fees up front to get a lower rate, then it's going to really not allow you to recoup that investment.
You must have tools and techniques that you're using today with your personal clients in order to save them the most money over time on their mortgage and debts. Can you answer that in 1 minute?
Couple quick things I'm doing. Number one is HomeBot. All my clients get HomeBot. We've talked about that. It tracks the rates and home values, notifies you of opportunities. Number two is your wealth team meeting. We've talked about other members of the wealth team, real estate pros, tax advisors, investment pros. You need to be meeting with every one of those 1 to 2 times a year. And the last thing is on my end, annual review with every single client, minimum of 1 time a year to evaluate their personal financial situation, their mortgage rate, their overall debt, and then pounce on an opportunity when it comes up. Maybe it's now, maybe it's in a year, but you got to be ready.
You're putting out a ton of new content all the time. So to keep all your listeners and followers from all over really up to date on what's going on in real estate, financial, and the mortgage world, just tell everybody really quick where they can find and follow you and maybe even see you.
Probably the best place to find me online is YouTube. My channel name is Rob Weinberg Mortgage on YouTube, all one word, Rob Weinberg Mortgage. You can also follow us on Facebook under Weinberg Mortgage, Instagram Weinberg Mortgage, and on Twitter we're on Weinberg Lending. So follow any and all of those to get up to date on all the future content we're putting.
And if you'd like to check out his website, it's www.connecticutmortgagelending.com. Once again, connecticutmortgagelending.com. By the way, if you've got a question that you would like to have answered right here on these very airwaves, it's really easy to do. Just email us at mortgagemattersradioshow@gmail.com. Again, specifically, it pertains to this radio show and podcast. Okay, if you've got a personal question, I'm going to give you the phone number that just, you got something that specifically pertains to you and it's personal, of a personal matter. I'm going to give you the number. But for general purposes in this radio show and podcast, mortgagemattersradioshow@gmail.com. His phone number, if you want to schedule that meeting that we were talking about earlier in the show, it's 860-413-3938. Once again, 860-413-3938. For Rob Weinberg, I'm Gary Byron. Thank you so much for listening to Mortgage Matters Radio Show and the Connecticut Real Estate Edge podcast. Until next Saturday morning, have a good one, everybody. So long.